Hello and welcome back to the Geordie Pig Investor channel. Today we're going to look at, is Chevron Corporation stock a buy right now? What is Chevron? Well, Chevron engages in the provision of administrative, financial management and technology support for energy and chemical operations. The firm operates through two business segments known as upstream and downstream. Some key components of Chevron are that they are based in America, they are part of the energy sector, they have a market cap of $268.5 billion, they went public in 1921, have over 42,000 employees, have a massive current dividend growth streak of over 36 years, which makes it a dividend aristocrat and only 14 years off becoming a dividend king, has a really healthy 5-year dividend growth rate at 6.49%, and has a dividend yield at over 4%. They're currently down 8.44% over the last year, and today we're going to break it down further and see if Chevron is a buy right now. Chevron's earnings calls and fundamental analysis. Chevron reported second quarter earnings of $4.4 billion with adjusted earnings at $4.7 billion. Production rose over 11%, boosted by the PDC Energy acquisition and Permian Basin growth. Despite operational challenges, Chevron returned $6 billion to shareholders via dividends and buybacks. The company also projects a 15% rise in full-year production, and TCO-related dividends are expected in future quarters, which is very exciting for people like myself who are invested not only because it's a solid company, but for those healthy dividends. We can also see that their net debt ratio is only 10.7%, which is one of the strongest in the industry, and they have plenty of different projects on the go right now, with one of them being the first oil production at the Anchor project in the Gulf of Mexico, and that is expected imminently, alongside of plenty of other projects which they're looking to be expecting growth of over 300,000 barrels per day by 2026. The fundamental analysis. Chevron have a positive free cash flow at over $18 billion. They have exceptional 3-year revenue growth at 19%, a positive operating income at $22.9 billion, positive gross profit at $77.6 billion, positive net income at $18.7 billion. They have really high interest coverage at 48.69, really good short and long-term solvency. They have a high Altman Z-score at 3.84. They have very low debt to equity at only 0.13. And their only negative is that they have positive net debt at $17.4 billion. So some really strong fundamentals across the company there, but to be expected for such a reliable long-term dividend payer. Moving on, we'll have a look at Chevron's free cash flow. Free cash flow is the money a company has left over after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. It'll have a massive impact on where the company is heading, and if you were to see a company that had multiple years of negative free cash flow in a row, this would flag up as being a bit of a worrying sign for someone like myself, because free cash flow is where the dividends are paid out from. Chevron's had some tough times when it came to free cash flow around 2014 to 2017, as it was in the negative throughout these years. However, they've continued to raise their dividend throughout this entire period and continue paying it with no issues. We can also see that it dipped quite significantly during the pandemic, but again, they continue to increase their dividend during this period and have maintained that healthy 5-year dividend CAGR. Any company that's actually involved with oil is usually fairly volatile because it's a very cyclical sector, but as long as the core fundamentals stay as they are, I'm not worried for a company like Chevron. They also have a payout ratio at 57%, which means they've got plenty of room to continue to pay these dividends and continue to increase them year on year. Next, we're going to have a look at Chevron's discounted cash flow valuation. The DCF is a method used to estimate the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flow based on a selected operating model. Chevron's current price is $146.83, and when I plugged in my numbers of 8.25% discounted rate with a negative 2.7% terminal growth, we can see that Chevron's slightly overvalued at 15%, being only worth $125.47. When I put in a discounted rate of 7.9% with a terminal growth rate of 0, we can see that Chevron's actually undervalued by 23%, being worth $191.26. And when I put in a discounted rate of 7.5% with a terminal growth rate of plus 2.7%, we can see the best case scenario that Chevron is massively underrated at 62%, being worth $388.44. Alongside the DCF model, I use another valuation method called relative valuation. The relative valuation is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics that I personally use are EV to revenue, EV to EBITDA, and I use PE ratios. When plugging in my numbers, Chevron's worst case scenario on their relative valuation came out at being an overvaluation of 10%, being worth $132.40. When I put in my numbers for the base case scenario, it came out of being undervalued by 21%, being worth $186.34. And for the best case scenario, it was undervalued at 36%, being worth $231.21. Once I have my relative valuation and my DCF valuation, I can then add these together and it'll make something called the intrinsic value. The intrinsic value of a stock has been used for many years by many different types of investors to calculate if they believe the stock was at fair, good, or bad value. Remember, CVX current price is $146.83. When adding these two together and getting an average, we can see on the worst case scenario, it was worth $128.94, an average case being worth $188.80, and a best case being worth $309.83. As well as using the intrinsic value, I like to use another method, which is Wall Street estimates, to really solidify my valuations for the company. What is the Wall Street estimates? Well, it's an average estimate of a public company's quarterly earnings and revenues that lead to a valuation of that company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is the most accurate valuation. For a company the size of Chevron, there's going to be multiple analysts looking at this company on a day-to-day basis and bringing out the most accurate prices possible. And this is why I like to add this into my valuation method when valuing a company. On the worst case scenario, the Wall Street estimates estimate that in the 1 year price targets, Chevron will be worth $155.54, which is a 6% upside. On the average case, they believed it would be worth $182.39, a 24% upside. And on the best case scenario, they believe it would be worth $215.25, which is a massive 47% upside. Once I have all three of my different valuations, I'll now combine them. I'll be able to get my worst, average, and best case scenario for Chevron. On the worst case, it was valued at $137.80. So with a 10% margin of safety, you'd be looking to buy at $124.02. And with a 20% margin of safety, you'd be looking to buy at $110.24. On the average case, it was worth $186.80. So with a 10% margin of safety, you'd be looking to buy it around about $168.12. And with a 20% margin of safety, you'd be looking to buy at $149.44. And finally, on the best case scenario, we can see it was worth $278.30. So with a 10% margin of safety, you'd be looking to buy at $250.47. And with a 20% margin of safety on the best case price, you'd be looking to buy at $222.64. Now, the question you're probably all bothered about answering, is Chevron a buy right now? I think this company is at a great price and it's a stock that has certainly stood the test of time, being around for over 100 years. With its relatively impressive dividend growth and strong dividend streak, I think it's hard to go wrong by having this company in your portfolio. It's one of the industry leaders, and highlighted in this video, you can see just how strong their fundamentals are across the board. Considering the price of Chevron right now and using a 20% margin of safety on my average case price, it is still undervalued. I believe it is at a really nice price right now, and I've actually been adding to this stock at this current price over the last few weeks, and I'll probably continue to do so as long as it's under that $149 mark. What's your thoughts on Chevron? Is it a stock that's in your current portfolio, or is it one that you're potentially looking to add in? Let me know in the comment section down below. I hope you enjoyed today's video. Please let me know of any other stocks you want a full breakdown on. Thanks for watching. Please like and subscribe. This is the Geordie Pig Investor. Over and out.